March 2027, that's when 60% of your portfolio disappears. Not a guess, not fear-mongering. Math. Every major crash in history follows the same 18-month pattern. 29, 1987, 2000, 2008, 2020. We at month 9 right now. And if you don't understand what's coming in the next 540 days, you'll be the liquidity that millionaires use to get richer. Let me show you the pattern they don't want you to see. March 2021, Reddit traders were gods. SPACs were the future. Everyone was a genius. 18 months later, September 2022, the S&P lost 25%. Inflation spiraled. Your stocks got cut in half. Go back further. October 2007, the market hit record highs. Banks were printing money. Anyone who said bubble was called an idiot. 18 months later, April 2009, the S&P down 57%. Bear Stearns gone. Lehman Brothers gone. Trillions in bailouts just to keep the system alive. It's not a coincidence. It's clockwork. And right now, we're watching it tick down again. Here's what they never taught you in school. The 1929 crash wasn't one day. Everyone remembers Black Tuesday when the market dropped 12% and investors jumped out of windows. That was just the crack, the warning shot. The real destruction took 18 months. From September 1929 to March 1931, the market lost 58%. But here's the part that'll make your stomach drop. It wasn't a lightning strike. It was systematic. People who bought the dip at down 20% watched it fall to down 40%. People who bought it down 40% watched it fall to down 58%. They kept averaging down, kept telling themselves it had to bounce back. Every rally lasted just long enough to give them hope before collapsing even harder. Because we're watching the exact same movie play out right now. But let me take you deeper into what actually happened in 1929, because the details matter. September 3rd, 1929. The Dow Jones closes at 381 points, its all-time high. A level it won't reach again for 25 years. At this exact moment, almost nobody sees what's coming. The newspapers are bullish. Investment advisors are telling clients to buy more. Irving Fisher, the most respected economist in America, is giving speeches about a permanently high plateau, but a few people see it. Joseph Kennedy, one of the most successful speculators of the decade, is liquidating his positions. He understands the mathematics of margin debt. When everyone owns stocks on 10% margin, a 10% decline wipes out their equity completely. Bernard Baruch is also out. He's converted to cash and government bonds by September. He's seen bubbles before. 1907, earlier panics. He knows the signs. Corporate insiders are selling in massive quantities. Not diversification, systematic liquidation. Executives who know their companies better than anyone are unloading 50%, 60%, 70% of their holdings. Why? Because they know the stock prices don't match reality. They know the earnings don't justify the multiples. They're cashing out while retail investors are still buying the dream. And here's the critical detail almost nobody notices. Corporate earnings peaked in the second quarter of 1929. By September, they're declining. Factory orders are falling. Industrial production is down. Commodity prices are weakening. The real economy is already rolling over, but stock prices keep climbing, completely disconnected. This divergence is the signature of the final stage, when prices rise purely on belief, on momentum, on the assumption that what went up will keep going up. This is where we are right now. In 1929, the trigger was margin debt. People borrowing money to buy stocks they couldn't afford. When stocks fell 10%, they weren't down 10%. They were wiped out completely. In 2025, we've got something worse, the everything bubble. Stocks at valuations that make 1929 look conservative. The Shiller PE ratio is at 35, the historical average. 16, it's only been this high twice before. 1929 and 1999, both times it crashed. Corporate debt, over $10 trillion, much of it borrowed at low rates that are now resetting higher. And the Federal Reserve has printed more money in 5 years than existed in the entire economy during the Roaring '20s. 21 trillion in the system, 6 trillion created out of thin air. But here's what makes March 2027 different. This time, everyone's retirement is in the market. Your 401k, your IRA, your pension. In 1929, when it crashed, most Americans didn't have their life savings in stocks. Today, through retirement accounts and pension funds, almost everyone with a job has a stake in this game. When it breaks, it's not just the rich speculators who lose, it's everyone. Your neighbor who's been diligently saving for 30 years. Your parents who are about to retire. Your friends who just bought their first index fund. All of them are sitting on a powder keg, and most of them don't even know it. Let me show you the numbers they don't want you looking at. Margin debt right now, $7.4 billion. That's not quite the record. We hit over $900 billion in late 2021 before the 2022 correction. But here's the kicker. It's been at elevated levels for 36 consecutive months. Every single time in history that margin debt stays elevated for more than 30 months, An 18-month crash follows within 6 months of the peak. We hit the peak in January 2025. Count forward 6 months. July 2025, right now, count forward 18 more months. March 2027. This isn't astrology. This is how credit cycles work in the real world. But it gets worse. Corporate debt as a percentage of GDP is at 47%, the highest it's been since they started tracking this metric in 1952. During 2008, 43%. And we all remember how that turned out. During the dot-com crash, 39%. We've blown past every previous warning sign, and yet CNBC is still telling you to buy index funds and hold forever. As if the lessons of history don't apply to you because you're special. Here's what they're not telling you. A huge chunk of that corporate debt was issued when interest rates were near zero. Companies borrowed billions because money was free. Now that the Fed has raised rates from 0% to over 5%, all that debt is rolling over at much higher rates. Companies that were paying 2% interest on their debt are now paying 7% or 8%. That's not a small difference. That's the difference between profitable and bankrupt. Think about it like this. If you have $1 million mortgage at 2%, you're paying $20,000 a year in interest. If that rate jumps to 8%, you're now paying $80,000 a year. Same debt, 4 times the cost. For companies operating on thin margins, that's a death sentence. And when companies start defaulting on their debt, the banks that lent them the money start having problems. When banks have problems, credit freezes up. When credit freezes up, the economy stops. It's not a complicated chain of events. It's just one that everyone pretends won't happen until it does. Markets don't crash because of bad news. Markets crash because of forced selling. When you borrow to invest, your betting prices go up faster than your interest costs. That works great for 12 months. You're a genius. Your friends think you're smart. You're convinced that leverage is the secret the rich have always known, and you finally figured it out. But around month 15 to 18, the math breaks down. Interest compounds. Asset prices stagnate or drop slightly. And suddenly, the people who were geniuses at month 6 are getting margin calls at month 18. They don't want to sell, but they have to. The broker doesn't care about your conviction, doesn't care about your thesis, doesn't care about your belief that you're right long term. The broker wants their money back now. So you sell at whatever price you can get. And when thousands of people do that simultaneously, prices fall faster, which triggers more margin calls. More forced selling, lower prices. It's a doom loop. And once it starts, it feeds on itself until every over-leveraged position is liquidated. Let me show you exactly how this played out in 1929, because the timeline is eerily similar to what we're seeing now. October 1929. The market opens with nervousness. It's choppy. Some days up, some days down. But the volume is heavy. Professional traders know what this means. High volume during a mature bull market usually means distribution. Smart money selling to dumb money. October 18th, Friday. The market drops sharply. It recovers by the close, but something feels different. Monday, October 21st. More selling. Tuesday, October 22nd. Heavy volume. Prices falling. Wednesday, October 23rd. Panic begins. By midday, a consortium of bankers meets at J.P. Morgan. Thomas Lamont, Albert Wiggin, Charles Mitchell, the titans of finance. They announce they're forming a pool to support the market. They buy stocks. The market rallies into the close. Friday and Saturday, newspapers trumpet the rescue. The bankers saved the day. It was just a disturbance. Everything's fine. But over the weekend, thousands of margin calls arrive by mail. Monday, October 28th, massive selling. The Dow falls 13% in one day. Then Tuesday, October 29th, Black Tuesday, the most infamous day in stock market history. 16 million shares trade. The Dow falls another 12%. In 2 days, the market loses 25% of its value. But here's what's important. This isn't the crash. This is the crack. The moment when forced selling begins, the moment when leverage starts unwinding. It's not over, it's just starting. And there's a reason this keeps happening. A reason the 18-month cycle exists. It's because that's exactly how long it takes for a new generation of investors to enter with fresh capital. Think about it. In 2021, it was retail traders with stimulus checks, convinced that stocks only go up, that GameStop was their ticket to retirement. In 2023, it was pension funds reallocating after missing the AI boom, pouring billions into Nvidia and Microsoft at valuations that made no sense. In 2025, it's a whole new crop of investors who think they learned from 2022, who think they're buying quality this time. The cycle feeds on fresh capital, and 18 months is the perfect window, long enough for the previous crash to fade from immediate memory, short enough that the structural problems never actually get fixed. The people who got burned in 2022 are mostly still licking their wounds, telling themselves they'll never touch stocks again. But the people who sat out 2022 and watched the market recover in 2023 and 2024, they're now convinced they missed out. And they're piling in with the desperation of someone who thinks they've found the last lifeboat off the Titanic. So why March 2027 specifically? Count backward with me. The peak hit in March 2025, the S&P at 5,800, AI revolution hype everywhere, the fear index flatlined. Everyone believed this time was different. Count forward 18 months. September 2026. That's when the crack appears, a 15% correction that everyone calls healthy. The financial media says it's just profit-taking. Buy the dip trends on Twitter. Your advisor sends you an email with historical data about how corrections are normal and healthy. Everything feels manageable. Maybe you even buy a little, because you've been waiting for a pullback. You've been told to buy the dip. This is what buying the dip looks like, right? Wrong. But the real crash comes in the final phase, 24 months from peak, March 2027. Not because of astrology, not because of mysticism, because that's how long it takes for all the over-leveraged positions to unwind, for all the forced selling to cascade through the system, for confidence to completely evaporate. But here's what makes this different from 2008 or even 1929. We're not just dealing with over-leveraged banks or margin-drunk retail investors. We're dealing with algorithmic trading systems that control 80% of market volume now. These aren't humans making considered decisions. These are machines executing instructions with no emotion, no context, no ability to see the big picture. When volatility spikes, they sell. When momentum breaks, they sell. When correlation across asset classes increases, they sell. And they all do it at the same time, at speeds measured in microseconds, creating flash crashes that wipe out billions in value before any human can even process what's happening. We're dealing with passive index funds that have poured $6 trillion into stocks regardless of valuation. For 15 years, buying index funds has been smart. It's been easy. It's been the right answer to almost every investment question. But index funds only work in one direction. When money flows in, they buy everything in the index, pushing all prices higher, regardless of whether companies deserve it. When money flows out, they sell everything in the index, pushing all prices lower, regardless of whether companies deserve it. There's no discretion, no analysis, no thought. Just mechanical buying and selling based on inflows and outflows. And right now, $6 trillion is sitting in passive strategies, convinced that buy and hold is a law of nature rather than a strategy that works in bull markets and fails catastrophically in bear markets. We're dealing with a generation of investors who've never experienced a real bear market. And I mean a real one, not a 6-month 25% dip that gets bought back in a year. The people who remember 2008 are mostly out of the market or in protected positions. They know what it feels like to watch their net worth get cut in half. The people driving volume right now, they were in high school during the financial crisis. They've been conditioned by 15 years of buy the dip working every single time. They've learned that the Fed will always step in, that stocks only go down temporarily, that patience is always rewarded. March 2027 is when that conditioning gets tested. And if history is any guide, it fails spectacularly. Here's your roadmap to the next 18 months. Right now, late 2025. Euphoria phase. The market might even make new highs, just like it did in October 2007, just like it did in September 1929. Everyone who was worried in 2024 feels stupid for not being fully invested. The people who were cautious feel like they missed out. FOMO is at peak levels. This is when even the skeptics start thinking, maybe I'm wrong. Maybe this time really is different. By spring 2026, we start seeing cracks, corporate earnings misses, credit spreads widening, unemployment ticking up from 4% to 5% to 6%. That weird feeling that something isn't right, but no one can put their finger on it. The financial media will have explanations. It's just seasonal weakness. It's just one bad quarter. It's just noise. But underneath, the foundation is starting to crumble. Major companies will start announcing layoffs. Not massive ones at first, just a few thousand here and there. Efficiency measures, they'll call it. Regional banks will start reporting losses. Write-downs on commercial real estate loans, on corporate debt. You'll hear about banks failing. Small ones at first. Banks in cities you've never heard of. But each failure makes people more nervous about their own bank. By fall 2026, the crack. A sharp 15 to 20% drop over a week or two that tests everyone's conviction. This is when people start asking the questions. Should I sell? Is this the big one? Or is this the buying opportunity I've been waiting for? Most people will buy, because that's what's worked for 15 years. Your financial advisor will send you charts showing that the market always recovers, that timing the market doesn't work, that you should stay the course. And for a few weeks, maybe even a couple months, it'll feel like they were right. The market will stabilize, maybe even rally 10% or 15% from the lows. The media will declare the bottom is in, that it was just a healthy correction, that the fundamentals are strong. This is the dead cat bounce. And it's one of the most dangerous phases because it gives false hope. It convinces people who are sitting on losses that if they just hold on, they'll recover. It convinces people who sold that they made a mistake, that they should buy back in. But underneath the surface, the damage is spreading. Banks are taking losses. Not visible yet, but real. Businesses are starting to feel the squeeze. Credit is tighter. Orders are down. They begin laying off workers more aggressively now. By December 2026, unemployment is rising noticeably, from 6% to 8% to 10%. People who lose jobs can't make their mortgage payments, can't make their car payments. More defaults, more losses for banks. The cycle is starting to feed on itself. Then January to March 2027. The real crash. This is when forced selling cascades through the system at scale. Individuals who held on hoping for recovery finally give up. They sell. Mutual funds and investment trusts getting redemptions have to sell to raise cash. They sell. Banks that need liquidity sell their stock holdings. Insurance companies facing claims sell. Everyone's selling. Nobody's buying. And when there are only sellers and no buyers, prices crater. The bid-ask spreads widen to absurd levels. You want to sell 100 shares? The bid is 20% below the last trade. You have no choice. You take it. Because if you don't, tomorrow it might be 30% below. Stocks, bonds, real estate, crypto, everything correlated to one, everything falling simultaneously. Nowhere to hide. Your diversified portfolio? Not so diversified anymore. Everything's moving together, down. The news will be apocalyptic. Headlines about the worst crash since 1929, comparisons to the Great Depression. Unemployment at 12%, 15%, maybe higher. Red lines forming, tent cities growing. The social and political consequences will be severe. Protests, unrest, calls for radical change. This is the capitulation phase, when everyone who was holding on hoping for recovery finally breaks, finally sells. And by selling, drives prices even lower, triggering more selling. Now let me pump the brakes for a minute, because everything I just told you is based on patterns. And patterns work until they don't. The Federal Reserve isn't the same institution it was in 1929 or even 2008. They've got tools now, unlimited quantitative easing, direct market interventions, the ability to literally buy corporate bonds if they want to, the ability to backstop money market funds, the ability to inject liquidity directly into specific sectors. In 2020, when COVID hit and the market dropped 35% in 4 weeks, everyone thought we were looking at another Great Depression. The Fed stepped in with $4 trillion in liquidity, and they stopped the crash cycle at month 2 instead of letting it run for 18 months. Could they do that again? Absolutely. Will they? That's the trillion-dollar question. Because the side effects of that intervention? Inflation, asset bubbles, wealth inequality, zombie companies that should have failed but didn't. Those side effects are exactly what created the conditions for the next crash. Every time they intervene, they create the seeds of the next crisis. But maybe this time they've learned. Maybe this time they can thread the needle. I doubt it, but I'm not arrogant enough to say it's impossible. And maybe this time genuinely is different. I know that's the 4 most dangerous words in investing. But hear me out. Maybe AI productivity gains are real enough to justify current valuations. Maybe we're on the edge of a technological revolution that will create trillions in value. That will make today's prices look cheap in hindsight. Maybe the corporate debt isn't as dangerous as it looks because interest coverage ratios are still healthy, default rates are still low. Maybe the passive investing revolution has actually created a more stable market structure instead of a more fragile one, because automatic inflows provide consistent buying pressure that smooths out volatility. I'm skeptical, but I'm not arrogant enough to say it's impossible. The future is always uncertain, and we remember the crashes, but we forget all the times people predicted crashes that never came. For every person who correctly called 2008, there were 50 people who called for a crash in 2004, 2005, 2006, and 2007 before it finally happened. Those people lost years of gains by being too cautious too early. Even a broken clock is right twice a day. The internet is full of perma-bears who've been predicting the next Great Depression since 2010. And if you'd listened to them, you'd have missed one of the greatest bull markets in history. So maybe this is just another false alarm. Maybe March 2027 comes and goes and the market keeps grinding higher. And this whole video ends up looking silly. I accept that possibility. But here's what you need to understand. The risk isn't that March 2027 is guaranteed to crash. The risk is that the conditions for a disaster are in place. And if you're not prepared, you'll be the liquidity that smart money uses to exit their positions. We've got the leverage, check. We've got the complacency, check. We've got the timeline. We're right in the middle of it. What we don't know is whether the powers that be will let it play out this time, or whether they'll intervene before it gets bad. My guess, they'll try to intervene. But this time, it won't work as well as it did in 2020, because the problems are bigger. Their tools are already being questioned. And the side effects of previous interventions are still working through the system, but that's a guess, not a certainty. So here's what you can actually do, and I want you to really think about this, maybe even screenshot it. Don't panic, but don't be complacent either. If you're 100% in stocks with no hedge, no cash position, no plan for what happens if we get a real 40% to 60% drawdown, you're not investing. You're gambling. You're betting that this cycle breaks, that this time really is different. Maybe it is, but that's a bet, not a strategy. Here's what a real strategy looks like. First, consider taking profits on positions that have run up significantly. I'm not saying sell everything, but if you bought something at 50 and it's now at 200, taking some chips off the table isn't being bearish. It's being prudent. You've already made 4x your money. Lock in some of those gains. Let the rest ride if you want, but don't give back all your profits because you got greedy at the top. Second, look at your portfolio's correlation. Pull up your holdings right now. Look at what happened to them during the 2022 correction. If everything you own went down when the S&P went down, you don't have diversification. You have false comfort. Real diversification means owning things that zig when other things zag. That might mean treasury bonds, might mean gold, might mean put options or inverse ETFs. It definitely means not just owning 10 different tech stocks and calling that diversified. Third, build a cash position, even if it's just 15 to 20% of your portfolio. I know how this feels. Cash feels stupid when markets are ripping higher. You're watching your friends make 20%, 30%, 40% gains, and you're sitting on cash earning 5% in a money market fund. You feel like an idiot. But here's the thing. Cash doesn't feel stupid when the market drops 50% and you are one of the few people who can buy quality assets at half price. The best time to make money in investing isn't when everything's going up. It's when everything's going down and you are one of the few people with dry powder to deploy. Warren Buffett understands this. That's why he's sitting on $325 billion in cash right now. He's not earning much on that cash, but he knows what's coming. And when it comes, he'll deploy that cash at prices that will make him another fortune. You can do the same thing on a smaller scale. Fourth, look at downside protection. I'm talking about put options on the major indexes, SPY, QQQ, IWM, or inverse ETFs that go up when the market goes down, not as a primary strategy. As insurance, think about it like this. You insure your house even though it probably won't burn down. You insure your car even though you probably won't crash it. You pay premiums for that insurance every year. In most years, you get nothing back, but you do it anyway because if the worst happens, the insurance saves you. Why wouldn't you insure your portfolio when the conditions for a crash are textbook perfect? A put option strategy might cost you 2% to 3% of your portfolio value per year. But if it saves you from a 40% to 60% drawdown, that's the best money you ever spent. And here's the beautiful part. If I'm wrong, if March 2027 comes and goes and nothing happens, you lose your insurance premium. That's it. 2% to 3%. Your stocks keep going up. You keep making money. You're just slightly less rich than you would have been. But if I'm right, that insurance could be worth 10x, 20x, maybe even 50x what you paid for it. Risk reward on that is pretty compelling. Fifth, and this might be the most important one, prepare yourself psychologically. Because here's what's going to happen if this crash plays out. Your friends and family are going to think you're crazy for being cautious. When the market's at all-time highs in early 2026 and you're sitting on 30% cash, they're going to tell you you're missing out. When the first correction happens and bounces back, they're going to tell you, see, I told you it was nothing. When the real crash comes in March 2027, they're going to panic. They're going to sell at the bottom. They're going to beg you to tell them what to do. And you need to be prepared for that emotional roller coaster. Because the hardest part of this isn't the analysis. It's not the math. It's not even the timing. It's having the conviction to position yourself differently than everyone else, and then having the courage to deploy capital when everyone else is terrified. The people who made fortunes buying in 1932 and 2009 and 2020, they didn't do it because they were smarter than everyone else. They did it because they had cash when everyone else was forced to sell. And they had the courage to buy when the news was apocalyptic. That's what I'm preparing you for right now. The real question isn't if March 2027 crashes, it's whether you're positioned on the right side when it does. Because if the 18-month cycle holds true one more time, the wealth transfer from unprepared investors to prepared ones is going to be generational. The people who see this coming and position accordingly will buy assets at prices that won't be seen again for a decade. Blue chip stocks at 50% off, real estate at 40% discounts, bonds yielding rates we haven't seen in 20 years. The people who don't will spend the next 10 years trying to get back to even, trying to recover from losses that were completely preventable, watching their retirement plans get pushed back, watching their dreams get smaller, all because they didn't want to look stupid by being cautious at the top. Right now, with everything I just showed you, which side are you on? Are you positioned to survive this, or are you positioned to be destroyed by it? If this opened your eyes, hit subscribe right now, because over the next 18 months, I'll be tracking this pattern month by month, showing you exactly where we are in the timeline, what specific indicators to watch for, when to take action. You don't want to miss those updates. They could literally be the difference between surviving this crash and being destroyed by it. The clock is ticking. 540 days until March 2027. And if history repeats, and it always does, most people watching this right now will ignore the warning. They'll keep doing what they've always done, buying and holding, trusting the system, believing it'll work out. And they'll learn a very expensive lesson about the difference between a bull market and a bear market. Don't be one of those people. Position yourself now while there's still time, because once the cascade starts, it's too late. The exits will be jammed, the liquidity will be gone, and you'll be stuck watching your wealth evaporate in real time. I'll see you in the next one. Let's see if the pattern holds.